Hi guys, it's Ian from Hola Prime and this is your weekly market wrap-up video. It is Friday the 4th of July 2025, just coming up to 9:30 in the morning in the UK. So today is a US holiday, it's Independence Day. The non-farm payroll figure, which normally lands on a Friday, was brought forward to yesterday. We got better than expected data. We saw a move higher in the US dollar. We also saw a move higher in stock indices. We'll look at the US30 today, hovering around the previous all-time high. We'll try and work out the outlook and the bias for that index. I'm going to concentrate this morning on DXY, which is the dollar index. We could be having quite an interesting setup in that. We'll then use correlation to highlight potential support and resistance levels in dollar crosses. I also want to talk about a technique that I use when analysing foreign exchange crosses and pairs. So I look at single currency baskets. So obviously DXY is the dollar index, predominantly made up of euro, but then we also have the Japanese basket, which is just purely yen, and then I've been able to work out a way of formulating other single currency baskets, and I use those to try and get a trade plan. Okay, so I'm using correlation. Obviously, if I'm looking at DXY going up, then I've got a strengthening single currency. I then want to look for a potential weakening single currency to trade that against. So for instance, if I believe DXY dollar index is going to move to the upside and I've got a bearish bias on sterling, then obviously the product that I'm going to be looking into is sterling against the US dollar. So we're going to look at that. We're going to talk about supply and demand zones, or order blocks, mitigation blocks, and we're going to use those as an overlay in today's educational video to try and sort of formulate trade plans. Okay, so obviously we can have a bias on where we believe currency pairs or commodities are going to go, but for me, one of the most important factors is always money management and risk against reward. So if I can get in to a single currency pair close to a swing low, then I know where I'm going to place my entry, my stop loss and my target, and with that I can then calculate my R rate, which is my risk against reward, and as far as I'm concerned, that's one of the most important factors with regards to trading, money management, and it also helps with the sort of psychological side, the fear and greed. You know, once we've planned the trade, we can then trade the plan. So let's get to the charts. For those that haven't been here before, these are trading view charts. Middle bottom is a monthly chart, then clockwise we've got weekly, daily, 8 hour, 4 hour, and then an hourly chart. On most of these, when you see these white boxes, that basically these are pivots, so it shows me the previous swing highs, which are obviously quite important when you're using such things as fib retracement, fib extension tools. You want them to be pretty exact, so that just gives me a highlight of where I should be putting my inputs. Okay, these dashed lines are my bespoke support and resistance levels. So showing my age, I've been in the markets now for over 35 years, and in that time I've developed sort of a bespoke support and resistance system. So the green, the yellow and the blue line highlight support and resistance. Obviously once support is broken, it then becomes resistance, and we can clearly see here on this daily chart in the dollar index that we're below most of these barriers. So this is short term, medium term and long term. I'm then going to look at, like I said, supply and demand zones or order blocks to basically try and find out good levels to enter trades. We're also going to look at cipher pattern formation. So a lot of analysts look at fib levels, retracement levels, extension levels, especially Elliott Wave traders. Obviously fifth wave extensions up towards sort of 261.8%. What normally happens when we're retracing in after a fifth wave, or even potentially after just wave one, that we will form inside cipher patterns. So these are known as a Gartley and a bat pattern. Okay, so it can give us more precise entry levels than just trying to guess where wave 2 is going to be, or guess where a medium term support level is going to be. And why is that important? Well, then again, as we trade, as we're planning our trade, we can use them as overlays. I don't believe that any sort of single indicator should just be used on its own. I like to overlay analysis on top of each other, so we get an overlay of this different types of analysis, and that gives us a better pinpoint area, or even the exact level to enter long or short trades. I should sort of explain now that I do look at swing trading. So I'm normally looking to hold trades for a couple of days, maybe up to a week, maybe even longer if I believe it's a medium term or long term swing trade. So this isn't really a scalping technique, but it can be used on an intraday bias as well, or basis, sorry. Okay, so dollar index. I think the most important chart is going to be this one here today. Okay, so this is the 4-hour chart. Now these retracement levels are slightly different than normal fib levels. So normal fib levels, you'll have 38.2, 50%, 61.8%, 78.6%, and then 0. Okay, cipher pattern formations are slightly different, and I'll give you the levels here. In fact, if we click on, it'll be a lot easier for you to see them. So 0.341, 0.618, which is common. So the uncommon ones, should we say, are 0.341, 0.545, 0.726, and 0.448. You might want to pause the video and just make a note of those. Okay, and why are they important? Because those levels make up cipher patterns. Okay, so what has a tendency to happen is that the markets move in waves, and these waves can sometimes be calculated. So we saw this quite decent move to the upside, and this is, remember, this is the 4-hour chart after yesterday's figures. So this is the 1 o'clock UK candle, 12 GMT, and we moved up, and but we've stalled here. Okay, 96.95, and that is the 34.1% extension. If we go to our fib tools again, okay, and then we lay the extension level over the top, we can see that we've got, this is potentially wave 1 coming down in 2, up in 3, down in 4, and then up in 5. And when we get these confluence areas, they form these patterns. Okay, I'm probably going to have to change the color of this so that we can just see it a little bit better. Been playing around with some of my settings this morning. Let's try the yellow. Okay, so this is a cipher pattern known as a bat formation. It will complete between 98.61 and 98.67. Realistically, if you're trading this pattern, what do you think you want to be doing? Well, there are two options. You can either try and trade the completion of BC for the leg up in CD, which is the impulsive leg up, or you can wait for the completion of the pattern and you can then trade it to the downside. why do you not want to trade it sort of mid-range? So obviously this starts moving higher, gets to about here, and I think, oh, I've missed this, I want to be longer dollars, I'm going to take a long trade, because your risk reward then gets completely skewed. And as I said in the sort of introductory part of this video, most important factor as far as I'm concerned, or one of the most important factors, is getting a decent risk reward ratio. So let's look at potential long position, okay, and I'm just putting it anywhere at the moment. So to grab the bottom of this BC leg, targeting the completion of the back formation and placing a stop loss underneath the swing low. Why is that important? Well, that is important because if this moves to there, then that whole formation is voided, okay, it's null and void, it's gone, because that pattern no longer exists. So if we can buy a dip in DXY, it's always if, because the market might just rally up, but if we can buy a dip in DXY, then our risk reward factor becomes around about 8 to 1. So we don't have to hit too many of these trade plans, or get too many of these trade plans correct to actually have a positive P&L. And remember, your risk factor should be set, so it should be 3% of your portfolio, or 5% of your portfolio. Some people go all the way down to sort of 1% of your portfolio. So that is the outlook on DXY, or potential outlook on DXY. Now go down into shorter time frames. So sometimes we get a bias from a monthly chart, not very often, okay, sometimes a weekly chart, daily chart, 8-hour chart, 4-hour chart, whichever time frame we get a bias from, we then want to break down into shorter time frames to look for potential inside patterns, potential solid entry levels, okay, and I believe that's what we're forming here. So again, we lay, just going to do this for you. So I get the retracement, cipher retracement tool, 96.96 I can see. Okay, what's happened? Well, I've moved lower and I've clipped this 54.545 retracement level, so nearly 50% retracement level, and I've started to move to the upside. So again, using cipher pattern formations, okay, this suggests that we'll actually get a deeper correction, because down here will form the back pattern. Okay, move my keyboard over a little bit. So back pattern will be confirmed at 96.03. Again, why is that important? Because I'm trading the completion of the pattern. Remember, we previously said we want to trade CD leg, or we want to trade the completion of the pattern. This is basically going to give us that correlation to potentially do both. So we're trading the BC leg on the 4-hour chart, we're trading the completion of the back formation on the 1-hour chart. It's going to give us a tight stop loss, and it's going to offer us a very decent risk reward factor. Now, what do I also like to see? Well, I like to see these. Okay, these are bullish order blocks. Okay, especially this one down below, and we can see that when we sort of trade or flick to different time frames, which I like to do, 60 minutes has got it here. Okay, why is this important? Well, that lines up with 78.6%. Okay, so if this moved lower to there, and then to the 61.8%, it then brings the 78.6% into play and this order block. So instead of being a bat, this becomes a Gartley, and that level would be at 96.13. Okay, so at the moment, and there's a great saying in the market, trade what you see, not what you want to see. And at the moment, what we see is a move higher from the 54.5 level. Okay, so it's not moving higher from 61.8, it's moving higher from 54.5. So at the moment we are forming, and I'm trading what I see, a bat pattern, but I've got bullish order block here. What if I go down to 45 minutes? It's still a bullish order block here. What about if I go down to 30 minutes? And then suddenly we've got some more correlation. Okay, so the order block on 30 minutes has acted as support and we're moving higher. We've then got another order block lining up with the 88.6% pullback level, which will form the bat pattern. So using different time frames, moving from a higher time frame, coming down into shorter time frames to get a decent support level, using cipher pattern formations, using order blocks, bullish or bearish. So how do we then use this? Because not many people trade DXY. You can on some platforms. The spread's astronomically wide as far as an FX product, or it's not really an FX product, it's an index concern. So we want to use that as a correlated trade bias. So if I want to be buying dips in DXY, I then want to be selling a different currency. Okay, so then that's why we have these single currency baskets. So you note here, if I open up my list, I've got a fair amount of different short product lists, if you like. So it's not the whole FX watch list, which is about 65 odd products. So the baskets: DXY, Euro basket, New Zealand, Japanese basket, Sterling basket, Swiss, Aussie, CAD. I sort of decent CAD set up overnight, but I couldn't really formulate a decent sort of plan around it, which was a little bit frustrating. And we've seen a decent sell-off in the Canadian single currency overnight, and that was a little bit annoying. Yeah, I suppose a little bit annoying. So sterling, we've got a resistance level up around here. So remember, these numbers might look a bit weird to you. 2,985 is the resistance level. That also lines up with a fib. So as far as I'm concerned, I want to be buying a dip in DXY. I also want to be selling a rally in sterling. I haven't really got a huge bias on other single currencies. I'm just going to go here and just explain this. Okay, so this again, remember time frames, we've got a daily time frame here, but what's really important here is that this is the euro and it's above all of these levels. Okay, so at the moment the euro is telling me that it's still got scope to move higher. I don't really see resistance until this huge great order block on the monthly chart. So at the moment that tells me correlation. Okay, I should be buying dips in the euro. So if I'm going to be buying dips in euro and I'm going to be buying dips in DXY, those two single currency baskets or two single currencies are really expected to go in the same direction. Okay, we might see intraday swings and we will see those intraday moves, but really I'm swing trading. I want to get on a trend. I don't want to get, I'm not worried about 10, 15 pips. I want 50 pips, 100 pips. So what I have a tendency to do is use these color-coded bars to highlight a bias, and I want the bias to be in the opposite direction. So here, DXY, light blue, I want to buy dips. Sterling, light red, if you like, I want to sell into rallies. And then I use that correlation to then formulate a trade plan. And I better get on with this because we've got 10 minutes left and I want to talk about some other different products. So sterling dollar, okay, how do we know the dominating move with regards to currency analysis or any sort of analysis? Okay, we want to be trading with this sort of trend. Okay, once that trend is initiated, then what will normally happen is we'll see a correction to the upside. So what's happened is we've seen this impulsive move lower, and then we get this choppy price action higher. Okay, we then want to look for areas of confluence. Okay, so did a piece for the STA, which is Society of Technical Analysts, a while ago, and the piece was called Correlation and Confluence gives Correlation and Confluence gives me confidence. Too many C's in there, but it's overlaying different factors to try and get a zone where there's more likely that currency cross will correct or turn to the downside. So impulse move, choppy wave price action to the upside. We've got a supply zone from here, which is the 1st of July, located at 1.3708. We've got trendline resistance located at 1.3707. So we've got some confluence there. Okay, we've got a corrective channel formation. We've got an impulsive move to the downside. We've got DXY saying buy dips. We've got sterling saying sell rallies. So again, we can start formulating a trade plan. What is good about supply and demand zones or order blocks? Well, we know first of all that institutional money is attracted to them. So according to sort of ICT, smart money concept, etc., institutional traders are going to these areas to soak up liquidity before the next move. Okay, what I also like about it is it gives you an entry level, it gives you a stop level. Okay, so to trade order blocks, we're supposed to initiate a short trade at the bottom of a supply zone, and the stop loss is placed above the top of the supply zone, so it gives you a defined entry and stop. So all we've really got to do after that is look for a defined target. Now remember, I talked about impulsive moves, corrective moves. A lot of impulsive and corrective moves will then form a flag pattern, and I believe that's what we've got here. So I put in bullish channel, but you could actually put in it's a bearish flag. It's probably not completed yet. So what we then want to do on a bearish flag, let's get my arrow, okay, is make a calculation. So I'm going to have to change the colour of this, excuse me. Okay, so flagpole 137.53, and that's why I like the annotations again. 135.63. Projected resistance level. Okay, so AB, so this is A to B, this is C to D. Horizontal line. Okay, got to change the colour of that. This is, or will be, your measured move. So the measured move is 1.3520. Okay, what do I have? What have I formulated? I've formulated a trade plan. So again, this is supposed to take, and notice I say supposed to take, the sum of the psychological stress of trading out of it, basically, because I'm planning a trade. I've got to trade the plan, I've got to set it, I've got to forget it. Okay, if it works, great. If it doesn't, then I know that in the long run, especially if I've got decent risk reward factors, I'm going to have a decent P&L. So I've got my entry, and I've got my entry formulated from using single currency basket analysis. I've got supply and demand zone or order blocks. I can use correlation and confluence on the sterling dollar chart. Impulsive move to the downside, corrective move higher, with a defined entry level 137.08. I've got a defined stop which is above the supply zone. I've got a defined target which is the measured move target of the flag formation. I can formulate a trade plan 5.5 R for a potential short trade in sterling against the US dollar. Okay, so that's an insight into sort of my sort of daily thoughts, thinking, and how I try and formulate trade plans. Sterling Aussie. This is just one that looks quite solid this morning. So again, quite an impulsive move to the upside. Can be seen in a 5-wave pattern, which should dictate that we are now in a corrective ABC formation to the upside. I've got a resistance level located at 2.0853. What I don't particularly like about this current trade plan, yes, I've got a support level at 2.0735, so I've got my entry and I've got my target, but this is a daily supply zone and it's huge. Okay, so where do I, if I'm sticking to the plan, okay, when the plan is to put the entry at the base of the supply, stop loss at the top, then I'm going to get skewed. Okay, my risk reward is going to come in at 1 or 1.2 or something very, very poor. So I'm always try not to break my own rules. Sometimes boredom, especially because I'm a swing trader, can become an element of fear of missing out, etc., FOMO. But you've got to stick to your trade plan. I want to talk quickly about gold. Gold is not my favorite product. And the reason it's not my favorite product is because apart from DXY, I can't really use another factor of correlation. DXY 10 years is virtually the same. Okay, I want to be able to get more into correlated products. So apart from risk on, risk off, it's not enough for me. So anyway, moved lower, hit this 61.8% fib, corrected higher. I think the prime resistance for gold is 3,394. The Gartley pattern will be completed at 3,192. I regularly analyze gold. I don't trade it very often at all. I mean, it really does have to line up for me to get involved in that pair, not that pair, that commodity. US30, and then we'll stop there. It's a huge bullish run, I believe, that we're in at the moment. So we've got this bullish channel formation. We've got a previous high at 45,098. We've got support at 43,681. Elliott Wave analysis would say wave 1, wave 2, 3, 4, and potentially up in 5. This might end up lining up with the channel top. Why are the order blocks so important? Well, I think this is quite a decent example. I know liquid markets today, obviously US Independence Day, but futures markets are open this morning, and most spread betting companies, CFDs, will be quoting. We've moved into this order block and we started to correct lower. Okay, so it's institutional traders soaking up liquidity, pushing it lower into support levels, and then potentially moving to the upside. So at the moment, I'm bullish or bearish, intraday bearish on US30, but I think that that dip will be bought into. Now this move to the downside is probably going to produce, again talking about correlation, an upward move in gold, and then I'm expecting a dip lower in DXY, but that dip lower to be bought into. By the way, that dip lower in DXY, we're probably talking about a corrective rally, but only maybe for a week or two, until that back formation is completed, and then we move to the downside again. Okay, I hope you found that educational, informative, and I hope you have a great weekend, and I'll be back next week with more analysis. Many thanks.
Hola Prime, trade with transparency.